day. Ira Epstein of Linn Associates with your agriculture wrap-up for this Monday, and we are now at April 20th, 2020 at about 3:45 p.m. Central Time. Interesting day. Crude oil prices went negative by $35 a barrel. Not making this up. They settled negative $35 a barrel. Now they've bounced since then, but the settlement is the lowest ever recorded. Biggest break. I've never seen them go negative, so I had an education. Didn't know how the computers would handle it. I got an education there. And the reason this has happened on the May contract, not further back markets, is because there's no storage area around for the May crude expiry, which is tomorrow. So the guys staying in there for the last trades, and most brokerage firms tell you don't do that. You know, it doesn't mean nobody expected the size of a break, but wow, it's a game worth of right at the end. Why are you in there? You know, and when a cash settled market occurs, that's different. The worst that happens is the amount of cash you're going to get one way or the other. But to trade the full size contracts like that, whoa, unbelievable. And now you get delivery if you're long. In the weekly area chart of soybeans, look at how the market has come down. We were talking last week, this market might have problems if it cleared 843. It has, and it's dropped right now as of today 17 more cents. So the market's still under tremendous selling pressure. On the daily chart, the support comes in right here at the 830 level. We're at 836 and a quarter. So you're in that zone. This is going to be a very important test of 4 days of lows made right there that resolved with a big rally at one point, 70 cents almost in the market. Now you're working your way back down there. The problem? Who's buying our beans? The problem, what are they using it for? China has less poultry, it has less hogs, it has less everything, and they're talking they don't need as much feed grain. I was reading that over the weekend. How are they going to honor their deal with us? Are they going to honor a deal with us? That's weighing on this market. I think it's on everyone's mind. When we come to the swing line study, there is no trend. A trend was right here, and I'll show you this one. Lower highs, lower low. Then the market gets a rally and it changes itself. Now it's got a higher low and a higher high. So the downtrend ended when the market took out this day's high of 868. Market comes up a bit here, playing, and then this break, which occurred last April 14th, almost a week ago, broke that. So now you have a higher high, lower low. That is the equivalent of no trend on the swing line. From there, the market just started sinking, and this is where you're at right now. The market ran into a buzzsaw at the 18-day average of closes. It had one settlement over it and then immediately right back under it. So that one was the one that set up, I guess, this rally high, and then you fell from there. Now you're down to the lower Bollinger Band. You round this to 834, today's low 834 and a quarter. You're right at that number. This could be where the pros start taking some money off. It is Tuesday tomorrow. You might get, after a good break today, a small bounce tomorrow. And I look for what's the momentum happening in the slow stochastic. And with today's close, both numbers are under 20 in the slow stochastic. Friday's got the numbers both under 20, and Thursday under 20, not Wednesday. 3 days in a row is all you need to get an embedded reading. Embedded converts a market from being oversold to locking in a bear trend. And that's what the market's done. More times than not, you'll see, you did it back here. And when you lose the embedded reading, you're looking for a spin away from that price, be it on the upside or the downside. Back here, you had a bullish one. Notice when it was lost, prices came down and down rather hard. So right now, the market's in a downtrend, falling, hitting an objective with an embedded reading. I think the pros are taking money off the table. In the meal market, you're still bearish with an embedded reading. You still have the lower highs, lower lows. We had a recent crossover, and this is a crossover. Look at the red line. That's your 18-day average of closes in your green. That's called a bearish crossover. Bearish crossovers, if you pay attention to what they should do, not what they do, should end up with the market making a lower thrust than the most recent thrust on the market. And that's exactly what the market did today. It came down, got as low as 290.30, taking out 291.50. From here, the question is how deep can the break go? But already the thrust downward, the crossover, has proven the bears are looking at that and they're working with it. When we take a look at soy oil, it's been caught in the Bollinger Band. You've gone from the high, now down to the low. This is an area where I think the pros are covering short. So I see the beans as a potential short cover and this market. That does not mean I'm bullish. Doesn't mean the trade is bullish. But when you hit a Bollinger Band, only 5% of the time do you settle outside of it. So it's a number the trade looks at. When you take a look at the corn market, you're in a bear trend. You've been in one. You've had this pattern, lower highs, lower lows all the way through here. You're still in it. Will you get down to the lower band of 319 3/4 roughly? Could. It's not much from here. It's only 2.5 cents, so we'll see if it can do that. Momentum down, bearish locked in, still everything bearish in this. In the wheat market, a piece of news on Friday came out that Russia was going to stop selling wheat through Europe. It's going to stop it. I believe it was July. They're putting a quota on the amount they sell and a time frame. Okay, that popped up our wheat today because we start competing for those markets. And Russia will come back to the market when they think that they have their ample supplies or they don't like what the U.S. is doing. And if you don't believe me, look at the price of May crude oil. This is engineered, in my opinion, by what the Saudis and the Russians did with the price war, getting oil prices to crack, and we're paying the price for it in our fields. In the sugar market, lower highs, lower lows, bearish. Under the 18-day average, bearish. However, you have a market that is oversold. So as bearish as it is, it's more or less trading sideways and hasn't been able to garnish any real momentum to the downside. Now, it could catch the shorts by getting over the 1060 level, because that could give you suddenly higher lows, then a higher high over the 18-day average in an oversold condition that is ripe for more short covering. So I think the number that the bear cannot allow to happen is taking out the 1060 level. In the coffee market, it's a churn, but the market, you can see where the definition of resistance is. It's the green line, the 100-day average to the 18. The pattern has been bearish with lower highs, lower lows. Momentum pointing down, not oversold. Market set up for a potential test of the lower Bollinger Band, and on rallies, I'd expect the pros to be protecting and selling their short positions into this 119.25 to 119.85 level. In the cattle market, it is a game of the 18-day average of closes. You've had a pattern of higher lows, higher highs. But with today's action, this 88.12 is lower than this number. So suddenly I have lower highs coming down there, higher lows into this pattern. In other words, there's no trend. We're waiting to see if one sets itself up. In the hog market, as long as the embedded slow stochastic stays embedded, the bears, I think, will continue to sell the rallies. Get the red line over 20 and short covering can hit you just like that. In fact, you could get up all of a sudden to that 18-day average before you knew what happened. But until that happens, these rallies get sold by the bears looking at that momentum probably more than anything else. You know, one of the things I like to do is teach people how to work with different parts of charts. Pivot points, if you've never seen them, are something to learn. Because during the day, it's where the trader's flow is in the market. A pivot point decides, it shows you a formula. Use the previous day's range. And it'll have the dashed line that most traders put on. That's the pivot. Then the resistance points are above the market and below the market. Those are the buy and sell areas. In other words, below it's your buy zones. Above it's the sell. And what you want to do is tie to it the slow stochastic. I created a 3-part series for you, free video series. Just go to our website, under free offerings, sign up for it. We'll get it right out to you. I'm Ira. You have a good day, and I'll see you all tomorrow.